Hello, and welcome to the November 2022 Economic and Market Update, presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. On the whole, October was a good month for financial markets, as they bounced after a difficult September. While interest rates continued to creep up, expectations of the Fed moderating its policy grew during the month, while better than expected economic and earnings news provided some cushion over fears for the future. The Dow and S&P showed strong gains, while the Nasdaq results were lower but still positive. Abroad, developed markets also did well, while emerging markets continued to pull back on dollar strength. Fixed income was mixed, with the aggregate index down slightly on those higher rates, but with high yields showing gains. The primary driver behind the rebound was increasing optimism that the Fed will slow its future rate increases. The expected top rate dropped back below 5%, and while this week's meeting is still expected to result in a 75 basis point increase, a slower pace looks more likely in the future. Driving that optimism has been slowing economic data, with consumer and business confidence pulling back a bit and taking retail sales growth and housing down with them. There are clear signs the Fed's rate increases are starting to work, and that should affect both inflation and future policy. Even though we do see some slowing, though, the economy is still growing. Job growth remains strong by historical standards, driving increases in both personal income and spending. Business confidence also remains healthy, and supporting this, corporate earnings have been beating expectations so far. So while the Fed's policies are working, so far at least, they haven't derailed growth. That combination was good for markets, as with lower fears on rates and better than expected earnings, markets benefited twice over. That said, though, there are also risks in play as we enter November. The midterm elections, depending on the results, could result in some turbulence. There's also the possibility that the Fed surprises with its comments, derailing the positive expectations that took markets up last month. And of course, risks outside the U.S., including Ukraine and China, remain very real. We're certainly not done with turbulence. But despite the headlines, last month's rebound suggests many of the risks may be priced into the market already, even as the fundamentals of job growth, spending, and corporate earnings continue to beat expectations. When the fundamentals are sound, the downside risks tend to be contained. And that's the bottom line here. The downside risks are real, but there are also upside opportunities over time. The big picture is that this too will pass. Market turbulence is normal, but as investors, we should keep looking at our long-term goals and not the short-term gyrations. That's it for this update. Thanks for watching. Join me in December for the next one, but until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.